Hello and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nichols.
And so on the show, we're talking about AfterPay and LayBuy and the impact on your ability to purchase a property, both as an owner-occupier or as a property investor. Now, this is such a fascinating topic. I was out for lunch with an old friend from way back, and she said, you need to talk about AfterPay and LayBuy because so many young people are using it, and people who are not so young as well, in order to be able to purchase things. But for anybody who hasn't heard of an AfterPay or a LayBuy, these are companies who are offering short-term finance. So it's a buy now, pay later model. So you might walk in, Andrew, to Ballantyne's and purchase, I don't know, some sort of dress for
I knew exactly where you were going
for
with this.
your partner.
Oh, right, okay.
And you might decide that you want to pay that over 6 payments. Instead of paying $600 straight up front, you might pay $100 a week for 6 weeks. But you can walk away with that dress straight away. So it's this short-term finance. And a couple of other players you might have heard of in the market are people like OxyPay or PartPay, where they really are just extending you credit. They give the money to the retailer straight away and everybody's happy.
Yeah, and actually there's quite a few different people you can use this for. Now, I've never had Botox, but I know people that have. I know that actually the person that someone goes to get Botox every now and then, actually has that as a service. So again, you get your face injected and then you walk off and you smile to... Oh, no, you don't smile to yourself because you can't anymore. You walk away and you don't have to make the payment straight away. You just make them over an extended period. And when you are talking about a larger amount of money, $1,000, that obviously quite helps with cash flow.
Do they even go that high to $1,000?
I love how you raise your eyes at that. Yeah, absolutely.
Because I think when they start you off at 150 and then you can go up over time.
Yeah.
Now, the way that these companies make money is they charge the retailer a fee a bit like a credit card. So it might be something like 2.5%. And then if you miss a payment, they're also going to charge you a $10 dishonor fee, for instance. But the money is really made on the transactions that are going through. Now, before we get into the impact on the ability to get a mortgage, why don't you just walk us through, Andrew, what's in it for retailers and what do we really need to be careful of as consumers because of this?
Yeah, this is a really interesting sort of part of this, and we did a bit of research to kind of look into, well, what's in it for everyone. Now, my generation and the Gen Zs, millennials and Gen Zs.
You're not a millennial.
I'm cuspy millennial. That they're all about the instant gratification. And so, they see something, they want it, they want to take it away now. The old lay-by that I remember my mum doing, you would pay it off over a number of weeks and then you would take the item afterwards. So obviously at a major disadvantage, which is why you might use a credit card. But now you might not have the money in your account today, or even if you do, you could have that offsetting your mortgage. If you've got a mortgage, you can take the item today and then make those weekly installments of, say, $100 and you get what you want now. Or the stores are getting people that, okay, well, maybe they couldn't afford to buy something, but now they can because there's a new option. And Ed mentioned a really interesting thing off air that his generation, whatever the hell that is, they're all taught that credit cards are bad. And so this is a way of kind of having a credit card without having a credit card. And the stats around this are fascinating. So the average order value now is 40% more through AfterPay. So people are more likely to spend more money. So of course the store's going to offer that because if you can get your buyers to purchase 40% more, why wouldn't you? The 2.5% is all of a sudden worth it. And you're more likely to actually buy something. Conversion online is 22% more. And I know from people who I've worked with on e-commerce businesses that abandoned carts is a huge loss to them because they've paid for the advertising, they've got someone committed, then they get to the last minute in the checkout and they might go away looking for a discount code and they never come back. To close a 22% more makes a huge difference to that bottom line. And one of the really interesting things is they have fewer returns. And it makes sense, right? If you go into Ballantyne's or you go into David Jones and you buy some shoes, for example, and let's say they're $600 because, again, we're just using that number, and you walk out the store and you get home and think, oh, I wish I hadn't spent $600 on those shoes. I'm going to return them. Actually, if you're paying it at $100 a week for 6 weeks, you're probably less likely to miss the money in your account. And that means, again, better bottom lines for these stores.
Now, that's a good reason why retailers are actually offering it. But what I want to say is, for us millennials out there, we have been told that credit cards are absolutely bad. And look, they're not ideal and you will spend more just like here. But it doesn't mean that a LayBuy and AfterPay is 100% the good fairy on your left shoulder and the best possible alternative. So there are two impacts on your ability to get a mortgage. The first is that you are going to spend more. And of course, that increases your monthly expenses if this is caught on your bank statements because you're spending more. The second impact is on your servicing. Now, this all comes down to the bank seeing that you have higher monthly repayments or small weekly payments coming out of your account. So I ran the numbers on this. So let's say that you were earning the median income in New Zealand for 2019. It's about 80.4 grand, $80,000. And if you've got a personal mortgage of 400K, you're single, living alone, one car, so basically the minimum monthly expenses you could possibly have, and let's say that you're going to purchase an investment property with a 4.5% gross yield. So all pretty standard numbers there. That's the setup of the scenario. So right now, you can afford to buy an investment property worth $411,000. So pretty entry level, but that's cool. You can purchase your first investment property. Now, let's say that you've got a $50 a week Afterpay because you went out and you bought a party suit, in my instance, that might be. Now you've got about $200 a month less UMI, less uncommitted monthly income, because the bank is looking at that, at your bank statement saying, well, they've got an extra $50 a week payment going out. That's just over $200 a month. So we need to take that off. They've got to take that expense off because you don't have that income available to service the investment property mortgage in the bank's eyes under their test conditions. Now, that means that you can only afford to borrow $340,000 for your investment property, which is 71K less. So that's probably the difference between being able to afford an investment property and not, is that $50 a week Afterpay or LayBuy. It's meant that you can't borrow $71,000 because there's $200 a week less in income going towards that servicing. So it has a massive impact. Now, Andrew, what I want to talk about as well is the impact if you're an owner-occupier. So let's say that same situation, young person, you're single, living alone, one car, earning that median income, $80,500 odd. So you could afford to borrow for your owner-occupier $614,000. So a good amount. You can go purchase a property, add in your KiwiSaver and your deposit. You're probably buying the median property in that case. You've got some good servicing. But chuck in that $50 a week Afterpay, and that rockets down by $37,000 down to $577K. Now, to be fair, that's still a good amount of money to borrow. But simply by introducing $50 a week in Afterpay for your own home, the amount you can borrow is down by $37,000. So whether you're purchasing for investment or your own home, the simple fact is that these can have a massive impact even if you don't have a current one. Because, of course, when the banks are looking at your lending, at your mortgage application, they're looking at 3 months' worth of bank statements. So even if you've paid off that Afterpay, they might still account for that because you could then go and redraw it like a credit card.
Yeah, and I think actually, although there's been nothing that's come out from the banks to specifically say this that I'm aware of, I guess they might start looking at this like gambling, right? So gambling, you're completely within your rights to go to the casino and put some money on black if you want to. But the banks kind of shy away from it a little bit. And I guess clothes shopping is not as addictive as the casino, unless your name's Lauren Humphreys. But I think that it's something that the banks will start to keep a closer eye on moving forward. And so the last thing we want to talk about is student loans. And this is a really interesting one. And only today I was talking to an investor about this, because often you might see a student loan, particularly if a couple have got together, they've both got student loans, they decide to have a child, and then one decides to be at home with the kid and the other's paying off their student loan, but then there's a residual left on the spouse's home.
And I should just say, obviously, this is a bit of a turn of topic going from Afterpay to student loans.
Sorry.
But younger people who this primarily would affect may have student loans as well. And it's surprising how much this can have an impact on your ability to borrow.
Yeah, sorry, I just rattled that off and went straight into there. And so the interesting thing about student loans is they're not calculated, the repayments aren't calculated on the amount that you owe. It's actually calculated on what you're earning. So say, for example, you're on the median income, which is $80,000 and you have a student loan, then your payments are $601.54 per month. Now, the way this is worked out is it's 12% of your income earned above $20,200. Really odd number, but $20,200 is the income that you can earn without making a payment to your student loan. Once you go above that, it's 12% of that amount.
It's actually a lot. Once you factor in the fact that you're already paying tax, which might be 25% of your total income, depending on what that threshold is, and then you've got to pay 12% in student loans, and then on anything you buy, you're paying 15% in GST. It's a pretty large payment.
Yeah, and so let's look at how this impacts on your lending ability. So again, if you're single living alone and you're looking to buy an investment property and you've got a mortgage already of $400K, it reduces your property lending from $411,000 to $214,000. You're not buying much with that. If you're an owner-occupier, on the other hand, it reduces your borrowing from a maximum of $614K to $512. So that's $102K less. So it has a major impact. Now, the investor that I was talking to today said, well, should we pay off, in this case, it was his wife that was at home with their daughter, should we pay off her loan? Now, the mother was working part-time and she was earning $20,000. So actually, she wasn't having to make any compulsory payments at all because she's under that threshold. So paying it off would have no benefit to the servicing whatsoever. If you're in a situation where servicing is tight and paying off a student loan might help out and you've got the equity to be able to do that, or you've saved enough of a deposit to be able to do that, maybe you look at paying off the higher income earners because that is going to have more of an impact to servicing than just paying off the higher loan.
Now, something that I'll just mention there is just a bit of a quirk. It's not actually property related, but if you hold your student loan for 25 years, they will then write it off. So if you start working, you haven't paid it off in 25 years, they'll write it off and you don't have a student loan anymore. It's been forgiven. Great, right? But here's the kicker. They'll then charge that to you as income, which you then have to pay tax on. So let's say you've got a $50,000 student loan. You've been, I would say, relatively smart because you've found a way not to pay it off.
But you're only earning $20,000 a year, but yep.
And then it's forgiven. Well, then you've automatically got $50,000 worth of income, which you've then got to pay a great big tax bill on, which on
$20,000 a year is going to make it quite hard.
Well, it depends how you're structuring your earnings, of course, as well.
Okay.
Just before we wrap up, I want to talk about, well, let's go back to AfterPay and LayBuy. Let's say that you've had some of these, which is not a bad thing. We're not telling you off.
No.
But let's say you have. Well, how do you get around it? Well, when you go and apply for that mortgage, you've got to present 3 months worth of bank statements. So what are you going to do? Well, just don't use your AfterPay or your LayBuy within that 3 months. The other thing you may have to do, depending on what the bank can see, if they can see that you've got that credit available there, because AfterPay or a LayBuy will provide you a limit of what you can purchase up to, perhaps you have to cancel that. And then if you really need it, you go and apply for it after you've got that mortgage. So there are ways to get around this. If you're not using it for 3 months, then you're going to be okay because they're not going to see this on your bank statements.
I think it still shows up on your credit check, and you do have to disclose those things though. So I guess ultimately, if you're not using it, get rid of it.
That'd be the best thing and the safest thing to do. Fantastic. Just before we wrap up as well, I do want to say we are looking for 5 financial advisors, preferably authorised financial advisors, but if you're exceptional, we'll of course have a chat as well. Now, if you would like to join the Opus team, then I am going to link in the show notes to where you can find out about that. Or if you're on seek.co.nz, if you type in financial advisor or Opus partners, it'll also come up. Let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. Hey guys, it really does help us get the message out to more people. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
I'm Andrew Nicol.
I'm going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.